trends and daily market performance. Download today. Register using your existing NCB online banking login credentials. To open an account or get more info, contact our Wealth Hub today.
Good morning. Good morning, one and all. Welcome. It's another bright, sunny day in Kingston, Jamaica. And welcome on behalf of our sponsors, NCB, National Commercial Bank, NCB Capital Markets. I welcome you to this, the first quarter 2023 release of the Jamaica Chamber of Commerce Business and Consumer Confidence Indices. It is my pleasure to host you. My name is Andre Gooden. I am a director of the Jamaica Chamber of Commerce and chairman of the Jamaica Conference Board. On behalf of the JCC, we certainly invite your participation and thank you for making the time to be here. The last quarter of 2022, we saw that business confidence dipped a little bit, but was still at pre-COVID highs. Optimism at that time about current business conditions continued its upward movement, and expectations about future business, however, was down. So let's see what Mr. Anderson has in store for us this quarter. I welcome from the executive chairman of Market Research Services, Mr. Dan Anderson, who will be doing our main presentation. Also from NCB, Mr. Jeffrey Brown, structuring and loan syndication specialist. And from NCB Capital Markets, Mr. Timar Jackson, assistant vice president, origination and structuring. And to our special panelists today, Mrs. Shulette Cox, president of JAMPRO. Welcome. Not the first time we've had JAMPRO, but first we've had Mrs. Cox as the president here on our panel, and we thank her for joining us today. Mr. Jeremy Barnes, managing director of FESCO, listed company on the Junior Stock Exchange, doing very well. And Mr. Rory White, chief executive officer of Seven Crave, one of those businesses that emerged during the COVID pandemic and are still doing very well. We will have there's a Q&A section, which I will ask anyone to put their questions in, and I will take as many of the questions as possible post the presentation by Don. So thank you all for joining us, and we look forward to an enlightening session. We're going to start this morning with Mr. Timar Jackson from NCB Capital Markets, assistant vice president, origination and structuring, who will speak to us a little bit about what he sees happening and what he expects to hear from Don and how we will negotiate the landscape. Over to you, Timar.
Thank you very much, Andre. I'm very honored to share a few insights on the current state of the global and local economy and opportunities and challenges that we currently face. I mean, this event on a quarterly basis is one that is well regarded, and as the representative of NCB Capital Markets, one of the sponsors of the event, I'm very pleased to be participating in this way. So I'll just get into it. As a financial institution, we recognize that inflation has been a significant headwind in recent times. Despite a decline in overall inflation, it is crucial to note that core inflation, which excludes the volatile energy and food components, has not yet peaked in many countries. And as central banks continue to put in efforts to tame inflation, it is threatening to slow the wheels of the global economy and may even cause a recession for some countries. This month, the IMF published its revised outlook on the global economy, and they interestingly shaved off 10 basis points of their previous projection for the global growth rate to 2.8% and 3% in 2023 and 2024, respectively. The downward revision reflects stickier headline and core inflation, coupled with the recent US financial turmoil, triggered by high interest rates and tight financial conditions. According to the fund, the recent failures of two US banks, Silicon Valley Bank and Signature Bank in particular, as well as the recent takeover of Credit Suisse by UBS, have added an extra layer of risk for the global financial sector and the economy, including Jamaica. Given the Fed's monetary policy tightening, the US Conference Board noted that the probability of a recession occurring in the US this year has risen to 99%. As we all know, a recession in the world's second largest economy can cause ripple effects for the global economy, and even more so for Jamaica, which is heavily reliant on the US for demand of goods and services, including tourism. Additionally, geopolitical uncertainties such as the escalation of Russia's war in Ukraine pose risks to global energy markets and food security in low-income countries, adding to the headwinds we are navigating. However, amidst these challenges, there are also silver linings that we can focus on. Locally, while still above the central bank's target range of 4% to 6%, inflation has fallen faster relative to some of our other Caribbean neighbors. Annual inflation for March 2023 was 6.19%, coming from a high of 11.79 in April 2022. Falling inflation is an indication that we might be approaching an important inflection point in this rate hike cycle. However, due to the uncertainties in the global economy and its attendant risks to the local economy, we see high interest rates remaining an embedded feature over the near to medium term. In this environment, we encourage investors to take advantage of opportunities in the local money markets, bond markets, and to lock in and benefit from high interest rates. This is also a good time to identify stocks with strong fundamentals that are being offered at depressed prices in line with the recent fall off in the stock market. Additionally, GDP growth has been better than we've anticipated, which is a tailwind for capital markets and presents potential opportunities for increased earnings for businesses. According to the Planning Institute of Jamaica, GDP growth was estimated at 5.2% in 2022 and is expected to come out between 3% to 4% for 2023. Furthermore, labor market indicators locally continue to be positive, with the latest unemployment statistics showing the country maintaining relatively low levels of unemployment. In addition, public sector workers who benefited from the recent wage increases are expected to have more disposable income. These factors are generally positive signals for the equity markets and can be seen as an indication that with the right governance, talent, and strategies, companies can take advantage of opportunities that exist and even benefit even in these uncertain times. In the current environment, it is critical that corporates explore diverse sources and types of capital to finance their business. At NCB Capital Markets, we pride ourselves in the fact that we are able to tailor solutions to each client's needs and offer them the flexibility they require as they pursue growth opportunities. The high interest rate environment has undoubtedly increased funding costs across the board. And as a result of this, we continue to encourage our corporates to utilize shorter-term financing solutions to reduce their interest costs. Among other things, we also continue to find creative ways to fund our clients using public or private equity, mezzanine type financing, and invoice factoring. At NCB Capital Markets, we remain committed to navigating the current economic landscape and identifying the opportunities that exist. We leverage our expertise, market insights, and innovative solutions to help our clients adapt to the changing circumstances and make informed investment decisions. In concluding my section of the discussion, while we acknowledge the headwinds in the global economy, we also recognize the silver linings that present opportunities for growth and stability. As a sponsor of this event, we are honored to be part of this important discussion on the JCC Quarterly Business and Consumer Confidence Indices. We look forward to a meaningful discussion among the participants that will follow, exploring ways to navigate the economic landscape together. Thank you for your attention, and we are excited to continue our partnership with JCC and all participants involved in this webinar. I'll now turn over to my colleague, Jeffrey Brown, from the Corporate Banking Division, who will share his perspective on this topic.
Thank you. Could you just move the presentation mode on the PowerPoint there, please? Thank you, Timar, and thank you again to NCB Capital Markets and National Commercial Bank for their kind sponsorship. Over to you, Jeffrey.
Thanks so much. Let me know if you're seeing it. Let me just click on this quickly again. Did the mode change?
Yes.
Awesome. Let me skip to the next slide. So thanks and good morning again to everyone present. Thanks to the JCC. We do value the partnership with the team. And thanks, Timar, for setting the stage of what is going to be a very insightful conversation with regards to how corporates are reacting to the current economic state, how our clients are behaving, and of course, how we are reacting to the economic realities of this quarter and the quarters to come. Now at NCB, the bank, we are partners with our capital markets colleagues. They look at other parts of the capital structure, but we are primarily responsible for loans and bank-related solutions. We are clearly regulated by the Bank of Jamaica, so a lot of what is exposed to Timar's clients is not necessarily the same things that my clients will look at, but we do face similar challenges as it relates to the macroeconomics. Now, what are our clients experiencing in an environment like this? Timar would have set the stage as it relates to high interest rates, as it relates to inflationary pressures, but we stay very close to our customers. We continuously have conversations with them quarterly, monthly, some daily and weekly, depending on the circumstance. And what we've garnered from them is one, there's clearly an increased cost of production, and that's a consequence of rising global prices. Two, there's an increased cost of financing, and that's directly related to the cost associated with borrowing. And because of the two preceding points, you would have curtailed capital expenditure budgets, because now to finance these expansionary projects, clients are faced with increased cost of capital, and they're curtailing those spends until they can see a better or more cost-efficient way of doing so. But on the other end of it, we're seeing where Jamaican dollar has become more expensive to borrow. And we've seen where the stability in the currency rate in terms of exchange between J dollar and US have pushed our clients to take more US dollar funding rather than Jamaican dollar, which is an interesting perspective, because pre-pandemic, the bulk of the borrowing would have been on the Jamaican dollar side because the cost of borrowing was predominantly cheaper than the US. So we see more US dollar loans, and because of the exchange rate stability, we're expecting people to stay on that side of the currency for the medium to near term. Now, as it relates to making our client resilient in an environment like this, we ask ourselves, how do we make them resilient? We definitely pay key attention to details, and as my colleague Timar would have alluded to, we do make bespoke solutions for our customers. So no two clients will have the same loan, no two clients will have the same structure, because we are particularly paying attention to what their economic realities are. We encourage them to stay on the shorter side of the curve in terms of borrowing because of the increased cost that you're facing to date. And as the solutions mentioned prior, We look at invoice factoring, we look at providing revolving lines of credit. And of course, reverse factoring is a part of the product suite that we offer to our clients. We do preempt the customers with industry data like we have here today. Once the data is made available to us, we do share that with our customers and have meaningful and insightful conversation with them about the perspective of what exists and what is to come, how they will position themselves, and how we can be their best banking partner as we traverse this economic environment. And of course, being bespoke means you have to pay keen attention to detail. And we are here at NCBJ, we definitely do that with our customers. So as we look forward in terms of what is on the horizon, we know with the impending global financial crisis, we may see some impediments as it relates to further tightening in monetary policy. We do expect that to happen. And I will anticipate that in the data coming from the panelists. The fiscal policy currently is focused on reducing debt and creating fiscal space for activities. But because of the cost of borrowing, we still see capital expenditure budgets being slashed as people try to manage the cost of borrowing. The sectoral growth we're seeing in Jamaica is predominantly within manufacturing and agriculture, with tourism being above pre-pandemic levels. We do expect them to be the hallmark of the economy in terms of bringing and pushing growth of foreign currency. We see more inflationary management from the central bank. We do expect them to either keep rates as they are now or slightly increase in future. And we do expect consumer spending to rebound, particularly in the public sector, as they anticipate payouts from the salary negotiations. Now, what I will leave you guys with as our outlook as it relates to what the bank is facing. There are three things that are happening in the background that is affecting the commercial banks that are not predominantly the same reality with the capital market side of the business. Now, everyone knows the interest rates are where they are, and because interest rates are rising, there's a liquidity pool. There's a little bit of Jamaican dollars available to circulate for lending. So we have the increased cost of borrowing. Now, the second point is that the BOJ would have made an announcement to increase liquidity reserve requirements against US dollars and Jamaican dollars. That's also another pull on liquidity, which again will increase the cost of borrowing. And thirdly and final, we do have the cloud of Basel III coming for the capital requirements of the commercial banks. It's a more prudent requirement as it relates to capital adequacy ratios. So that will also have a pull on the amount of capital that's available for loans and lending to our large corporates and individuals. So I do expect rates to be where they are now or slightly increase as it relates to borrowing. So I'll set that as the stage for the panelists to come, and I'll pause there and take any questions if there's any. Over to you, Andre.
Thank you. Thank you very much. So just before we go into Don's presentation, NCB is suggesting that is expecting from Don's analysis that investments in agriculture and tourism should continue at so let's see if that is corroborated by Don's situation. And the other thing I would mention out of your presentation is that yes, with the reserve requirements changing, there are some indications of upwards movement in borrowing rates. So it's a good opportunity for businesses to really recalibrate their mix of debt and equity. As Timar suggested, the stock market is an option now for cheaper long-term financing while you consolidate the existing debt as well. So it presents an opportunity, and then the asset managers among us will certainly accentuate the opportunity to give businesses the opportunity to finance their projects out of equity rather than debt. Meaning making an affordable mix of both debt and equity, of course. So we look forward to, thank you for that presentation, and we look forward to seeing if in fact what has been alluded to in terms of the areas for growth in an economy such as this actually come to fruition, and if those are reflected in the sentiments expressed by businesses and individuals. So without further ado,
before you go, Andre, let me just add one more thing. That one of the behaviors that we didn't mention was the fact that a lot of clients are using the opportunity for the ones who have excess deposits, they're paying down their liabilities significantly and managing their exposure to borrowing. So that's one of the behaviors that we're noticing.
Right, because the cost of borrowing and the investment cost is a big gap between them. So if you're saving at 3% and borrowing at 15%, that don't make no sense. So it presents an opportunity to sort of rebalance. All right, so thank you very much. We're moving steadily along, and we are on time. And we now invite Mr. Don Anderson, our main presenter, to present us with the presentation of the 2023 Q1 Business and Consumer Confidence Indices. Morning again, Don, over to you.
Good morning, Andre. Good morning to all your panelists. Good morning to all your audience. Let's keep growing. It's always a pleasure for us at Market Research Services Limited to be able to collect this data in the first place, and then to make the presentation to the nation and other participants every quarter. So we are now going to be presenting the results of the first quarter for 2023. I want to give you a background to the study very quickly. It's always important to contextualize the data. So we carry out a nationally representative sample survey of the general public 18 years and over, and we interview approximately 600 persons. That's our target. We get generally more than that because we have a 10% overfield. So it's anywhere between 600 and 660 persons that we interview on a regular basis, almost every day throughout the year. We then interview a minimum of 100 companies across all the industry types. And from that data, both the 600 and the 100 were able to project the data up to the national situation. It's important to, again, contextualize where we're coming from in the first quarter, where we're coming from to arrive at the first quarter. Because during 2022, coming out of the pandemic, we saw gradual increases in the consumer confidence. We saw, on the other hand, a kind of roller coaster movement of the business indices, probably most evidenced by some gradual movements in the first two quarters and a huge jump of about 18 percentage points in business confidence in the third quarter, as more and more companies opened their doors and more people were coming back out. There's a freeing of the minds, so to speak. And as a result, we found a huge jump in business confidence during the third quarter of 2022. By the fourth quarter of 2022, whilst consumer confidence inched up a little bit, business confidence not only leveled off, but fell a little bit. And that was a point of concern, generally, when we looked at the different indices that we gathered and that we collected and reported on in the fourth quarter of 2022. So fast forward to the first quarter of 2023. What do we find? It's not usual for consumer and business confidence to follow virtually identical patterns of movement in the same quarter. On this occasion of the first quarter of 2023, it is clear that the indices moved in the same direction and almost to the same extent downward when compared to the fourth quarter of 2022. So I'm going to start sharing my screen now and to give you quite a clear picture, I believe, as to what came out of the, right, here we are. We'll go to our presentation mode. So what has the first quarter actually shown up in terms of our data? So let's get the kind of glossy and fussy charts out of the way first of all. And here we are now to the first piece of data. We find that consumer confidence fell by approximately 2.7 percentage points in the first quarter of 2023 compared to the fourth quarter of 2022. So what we have, therefore, is a reversal of the gradual growth and improvement and increase in the consumer confidence during 2022 to now we have a slight fall off of 2.7 percentage points in the first quarter of 2023. So we want to drill down and look a little bit more at what is taking place. So when we went into the field interviewing over 600 persons across the island, one of the first things we found out was that during the first quarter, people had a pretty positive view or a more positive view of current business conditions than they did in the first quarter of 2022. And we use that generally as a good period of comparison, but we also look at what is the change between the first quarter of a year or the first quarter or any quarter compared to the previous quarter. But right now we're looking at the first quarter of 2022 compared to the first quarter of 2023. 10%, 11% in 2022 considered that the current business conditions were good. That moved up to 15.7% in the first quarter of 2023, current business conditions. As a result, we found that there is an increase or a reduction in the number of negatives. So whereas 24.3% said in 2022 first quarter that current business conditions were bad, we're still in the COVID situation, that fell in the first quarter of 2023 to 20.4%. It's always important to use the current job reading of the consumers as an important indicator. In the first quarter of 2022, that was 5.1% who felt that jobs were plentiful. And I make the point constantly, that consumers have never felt jobs were really significantly plentiful. So against that background, 5.1% in the first quarter of 2022 compared to 11.3% in the first quarter of 2023. So consumers are saying, at this point in time, business conditions are good, and I believe that jobs are becoming more readily available. 15% only said that jobs are plentiful. So generally, almost 50% feel that jobs are in short supply. This is a general situation that we've picked up over the years. Consumers have never felt that jobs have been plentiful. So that's the current situation. We want to look at how consumers see the situation going forward. Note against the background of what they consider to be an improvement in current business conditions compared to last year, consumers are now saying, well, we believe that business conditions are not going to be as good as they were during 2022. And this is the first quarter reading. So whereas 38.9% felt that last year that business conditions were going to be better, that number fell to 29.8% in the first quarter of 2023. So that going forward, consumers are saying, well, business conditions may not be all that great, may not be as good as it was when we looked at 2022 going forward through 2022. It is not going to be as good 2023 going forward. So we also recognize that there's a slight increase from 26% to 26.9% of the consumers who felt that conditions were going to be worse, business conditions. So consumers are, at this point in time, not particularly positive about business conditions going forward. So what impact has that had in terms of their expectations about jobs? Note, therefore, that this has impacted negatively how they see jobs going forward. 38.9% in the first quarter of 2022 said they expected the job situation to get better. But when we look and fast forward to the first quarter of 2023, that situation, that number has fallen to 33.5%. So there's a 5 percentage point fall off in the number of consumers who feel that jobs are going to be more readily available. And as a result, we find that consumers are less optimistic about the situation going forward. What about their household income? it is interesting, therefore, it's almost counterproductive and counterintuitive that despite this, consumers are saying, well, we expect our household income to change for the 4.6% first quarter of 2022, and that moved up to 48.7% in the first quarter of 2023. So are they optimistic or are they just hopeful? This is the issue that is probably still moot. We're not sure, but what the consumers are saying is that despite the fact that going down the road, business conditions may not be as positive as we thought they were going to be in 2022, we still expect our household income to improve. And there's an answer for it in a few charts from here on. But at the same time, we believe that their intention to purchase measures are being, in a way, supported by, cushioned by, freeing up the mind, so to speak. Because when we look at the situation, we find that persons are saying, we're going to be purchasing, we're increasing our purchase intent. Homes, vehicles, and in particular, vacations. And the theories and the information that we're picking up is that people are kind of now feeling the need to escape from the bonds and the boundaries that were put on them by COVID, and are flexing their own thinking to make some vacation, take some vacations and go travel somewhere along the line. Okay? So whilst consumers are negatively inclined in terms of progress going forward in 2023, they're also at the same time saying, boy, we're going to burst out and do things. Vacations in particular is what they're looking at. Now, what is the impact in the comparison first quarter of 2023 compared to the last 4 years? We can see in 2019, when the consumer confidence peaked at 180 points, it dropped during COVID year, massive COVID year of 2020 to 150. Fell even further to 140 in 2021, again in the peak of COVID, but began to pick up during 2022 when we began to relax the kind of shackles that COVID put on us, and that moved up to 160. So that's the average for 2022. And that was evidenced primarily by that significant surge in in consumer confidence and business confidence during the third quarter of 2022. In the first quarter of 2023, consumer confidence has dipped a little bit. We said 2.7 percentage points overall. And that is reflected, first of all, in the first quarter data that we have just shown. So we can see exactly what is taking place. And it's important to note that the first quarter represents a fall off. The question, of course, comes back to haunt us. Is it a question that people were peaking towards Christmas 2022? And the data is suggesting that that might have been a factor. That in addition to the increase, certainly from a business confidence perspective, of 18 percentage points and a gradual increase in consumer confidence, that people expected Christmas, the last quarter of 2022, to be good. And it did, in fact, suggest that that might be the case, except for a slight fall off in business confidence. So we asked the question. Some persons felt that the economy was going to be better, but more persons felt the economy was not going to be as good. And that 21.8%, we said, well, what are the conditions? What are the factors that are playing out right here in terms of that 21.8% who said that business conditions are going to be better? One, most important, they said they're being optimistic. They're not placing this whole perspective of the economy improving on anything concrete. They're just being optimistic. Two, they believe the economy is recovering. Three, they're saying more business sectors are opening. Four, the COVID threat has been reduced. Five, they're trusting in government policies. So strategies are in place as well. So here are the factors that they are advancing as, or in support of, their view that business conditions, the economy, is going to be better in the next 12 months. 21.8%, mark you, less than those who believe that the economy is not going to be as good. And this is significant to note that 52.3% of the persons that we interviewed, 600 and odd persons that we interviewed in a nationally representative sample across Jamaica, of course, in all socioeconomic groups and all age groups, 18 plus, 52.3% said the economy will worsen in the next 12 months. That's a huge comment. Why are they saying that? They point particularly to the high cost of living, the cost of acquiring things that they need for their daily household existence. Second thing, the high crime rate. Very important factor. These are all spontaneous responses. No prompts were given to respondents. We asked them, well, you say that business conditions are going to be worse in the next 12 months. Why is it? And we have recorded exactly what they've said. The number one factor, the high crime. Number two, the high crime rate. 3, government not doing enough for the economy. 4, the lack of employment. And 5, we have these are the issues that are coming to the fore. Very important to note that these are the things that people are spontaneously making mention of. High cost of living, high crime rate are 2 factors that are impacting significantly how people view the economy going forward. So these are the influences on those persons who are saying in the first quarter of 2023 that the situation is not going to be as good as it was as when we were looking at the same situation in 2022. So one of the things we did, and it's important to explore this a little bit because the most significant factor mentioned was the high cost of living. So we asked them, how do you find prices are comparing to, say, last year? Price of items normally purchased compared to this time last year. 77% say that prices have significantly increased, not just increased, but significantly. 20% moderate increase, but bottom line is almost everybody is saying that prices have increased. This is something we know, but the fact is that a significant percentage are saying there has been a massive increase in prices over the last year, 77%, whilst 20% say there has been a moderate increase in prices. So these are key factors that we need to note. Now, we want to look at a piece of data that in 2010, in its own wisdom, the Chamber of Commerce decided we're not quite understanding some of the parameters that are playing out in this data. So they introduced a question on remittances in 2010. We can see the pattern over the years. And what's important to note is from a situation where we had a gradual, almost a sort of even distribution from 2011 when we started to monitor it through to 2020. In 2011, 35% of households received remittances. In 2020, the same 35% in number received remittances. But in 2021, COVID, 29%, that fell off to 29%, a 6 percentage point fall off, and it fell off even further in 2022 to 26 percentage points. So between 2020 and 2022, there was a reduction of 9% amongst the households who were receiving remittances overseas. Now, the first quarter of 2023, there has been a revival, so to speak. The number of households receiving remittances moved from 26% in 2022 to 34%, 31% in 2023, first quarter. And this is also therefore playing out perhaps in the degree of confidence that persons are showing that they could make some plans for 2023 in terms of taking vacations and so on, because the households are now receiving more remittances and more households are receiving remittances. So their note on the bottom says 34% of the persons interviewed said are receiving more remittances than 3 years ago. That is back into that 2020 data. 27% are receiving less. Overall pattern is that there has been an increase in the number of households receiving remittances, and by extension, an increase in the amount of remittances being received. So this is in fact going to shore up their ability to meet their daily household expenditure. Now we have data which has shown consistently that very little of the monies that come in via remittances is saved. And the simple reason is that much of the remittances is going to the low socioeconomic groups, the low and low middle. And as a result, these persons are using these funds to take care of their daily household expenditure. Very important factor to note. So this is what is taking place as far as the consumers are concerned. There has been a 2.7% fall off in confidence amongst consumers. They feel that current situation is better than it was in 2022. Again, COVID was still with us very much in the beginning of 2022. So when they looked forward to 2022, they thought, well, the thing was going to get better. Hoped it was going to get better, but they said it was going to get better. When they look at the situation in 2023 first quarter going forward, they're not as optimistic. And there is a feeling amongst consumers that the economy is going to be more difficult for them during 2023. One of the key factors is the high cost of living, and the other factor that is of significance is the high crime rate. We need to make note of those 2 points. So we want to now turn our attention to the business sector. What has happened in the business sector? We note that in the third quarter of 2022, business confidence soared by 18 percentage points, third quarter compared to second quarter. 2022 was a kind of a roller coaster year because the 2 quarters prior to that, there was a dip in one, but in the third quarter of 2022, a surge of 18 percentage points, almost unprecedented, that level of movement in any quarter since we started to monitor this. But that, I believe, understandably so, fell off a little bit during the fourth quarter of 2022 because that's a huge surge. And what we found was that it began to level off in the last quarter of 2022. Well, that leveling off has continued through to the first quarter of 2023 because business confidence fell by some 5 percentage points between the last quarter of 2022 and the first quarter of 2023. What have been the contributory factors? We note the pattern is somewhat the same as it was for the consumers. In the first quarter of 2022, 15.9% expected their profits to be better than normal. That moved up in the first quarter of 2023, current situation, to 20.2%. So there's a slight increase in the number of firms that expect their profit, their current profit, to be better. And therefore, there's a concomitant decrease in the number we expected their profits to be worse, from 24.8% first quarter of 2022 to 20.2% in first quarter of 2023. Very much the same kind of pattern that was developing amongst the consumers. So when we talk to the businesses, over 100 businesses that we talk to, various industry types, in the first quarter of 2022, 47% said it was a good time to invest. When we fast forward to the first quarter of 2023, that number moved up to 56%. So there had been a 9 percentage point movement amongst those businesses who felt it was a good time to invest first quarter compared to 2022. Again, perhaps understandable, because during 2022, the situation changed. COVID began to recede. Businesses were opening up again. Offices were, in a way, re-engaging persons, even if not bringing them back into the office to the extent that they were before. And therefore, there was a gradual level of optimism going forward. So this is where we are. First quarter, 56% said it was a good time to increase their capital expenditure. But going forward, what are businesses saying? And I made a point earlier that it's unusual consumers and businesses following in the same pattern in any one quarter. But this is what is taking place here. Because when we ask businesses about the economy going forward, there's a substantial reduction in the number of businesses that felt things were going to be better. First quarter of 2022, that percentage was 56.4. That fell to 41.3. Caution, reservation, what have you. And by extension, there was a concomitant kind of decrease in those who thought the situation was going to get worse. But note, very few people relative to 2022 felt that the economy was going to get better. Interesting to note, and again, very much the same kind of pattern as the consumers. Despite this, 75% of the businesses expected their firm's finance, not their profit, but their finance to improve. And that is a movement from 72.7% in 2022 first quarter to 75.2% in first quarter of 2023. What about profitability? Persons expected a slight dip, back to 65.1%. 65.1% of the businesses expected it to improve, as against 66% in the first quarter of 2022. So the pattern between consumer reaction to things going forward in 2023 and the pattern of businesses looking at the thing going forward in 2023 up to this point in time is following along the same trajectory. So what does this mean? Let's look at the 5-year trend in terms of business confidence. We note, again, in 2019, that was the peak in the last 5 years. 143.6 was the index of business confidence in 2019. That fell dramatically to 120.5 in 2020, up to 124.9 in 2021, and then again a substantial improvement to 137 in 2022. Buoyed, we repeat, by that substantial jump in the third quarter of 2022. First quarter of 2023, that number is 137. So it is less than it was in the fourth quarter of 2022. We asked those businesses how they felt about the economy, and we can see that the businesses are a little bit reticent, a little bit negative in terms of what they expect about businesses going into 2023. 41% believe that the conditions are going to be better. So we did the same thing. We asked the same questions that we asked of the consumers. Well, why do you say so? Again, the top reason that they gave is the same kind of reason that the consumers gave. Nothing that's concrete necessarily, but number one, people said the economy is recovering. Okay, the economy is recovering. Number two, they're being optimistic. So our businesses not basing their expectations on concrete grounds. There's room to suggest that this is the situation. 3, government policies are being put in place. 4, they expect the tourism sector to rebound. And 5, people are saying opportunities abound. Opportunities are there. So the economy is recovering. Businesses are being optimistic. Government policies are being put in place. So this is probably one of the top 3 concrete reasons that businesses are given for feeling that the economy is going to be better during 2023 than it was prior to. Note, 27% said business conditions are going to be worse. We asked them, why do you say business conditions are going to be worse? Well, they're putting forward a number of different reasons. We note the whole question of the importance of the supply chain problem, high prices for goods and services, global trends, increase in crime. And these are factors that recur time and time again in terms of the evaluation. The economy don't expect to improve that quickly. High prices for goods and services, global trends, increase in crime. These are factors that they're putting forward as things that will retard the growth of the economy during 2023. Very important factors to note. Now, one of the key questions that we added most recently, and we're talking about 2021, because we were always being asked in presentations, well, what are the sectors that are likely to increase their capital expenditure? Because we saw indications to expand, certainly up to 2020. The economy, businesses were bullish. They were going to invest. They were going to increase their capital outlay. And we couldn't quite figure out where were these segments that the sort of growth was going to take place. Well, we've been tracking it from 2021. We can see the pattern 2021, 2022. We look at 2023, and we can see the sectors that are poised, or people say they're going to be basically throwing more capital behind. And we can see that the agriculture sector is one, transport, storage, and communication two, wholesale and retail, and one or two others. So these are the ones that businesses are saying they're going to be increasing their capital expenditure during 2023. And it's important to note that these are that we need to, I'm sure NCB will be looking at this particular chart more closely than with others, because it talks in terms of, okay, where can we kind of set up a kind of relationship with what sector? And that is what this particular piece of data is actually pointing. So that was the last chart. I just want to recap by saying, for the first quarter of 2023, the pattern of movement from the consumer's perspective was not different from the pattern of movement by the businesses. Both fell off in the first quarter compared to the fourth quarter of 2022, but showed improvement over the first quarter of 2022 because we're still in COVID. Therefore, the year 2022 was where we evidenced the kind of recovery, the kind of growth taking place, positive movement taking place. That movement, which peaked in the fourth quarter of 2022, has begun to slip. 2.7 percentage points amongst consumers, 5 percentage points amongst businesses. They have indicated what are their reservations. And we can see where prices in terms of the consumers, significant increase in prices that they're experiencing against the fact that there is not a great increase in employment is one of the key factors that consumers point to. From a business perspective, they believe, remember, businesses are in there for the long haul, and they believe that it will take a while for the situation to adjust itself so we can experience continued growth. But right now, they're not seeing that. And they're saying, well, it's going to take a while for the economy to pick up. And in the meantime, we're going to be challenged by global supply chain problems. Crime is a factor that they're pointing to. And generally, therefore, for the first quarter of 2023, there is a conservative approach being taken to the point where people aren't overly optimistic, neither the businesses nor the consumers. In fact, they're less optimistic about things going forward in 2023 than they were at the start of 2022. It is easy to understand. It is logical coming out of a COVID year that as the situation began to ease, people were very optimistic about things going forward. Now that COVID is behind us, and maybe if you wish a reality check, businesses and consumers are not as confident going forward as they were at the start of 2022. But that sums up the data. And as it said, we are now open to comments and questions, and we hope that we can answer all of them adequately. Thank you very much. It's been a pleasure to present again.
Thank you.
The data has been clear enough for all to review and to absorb. Thank you very much.
Thank you very much, Don. Don't mute your mic yet.
No, I'm not stopped here.
This is very interesting. It's the first in a long time that I recall seeing both the consumer and business moving in the same direction. Could you first say, to the best of your recollection as a statistician, when last this actually occurred? That's the first thing I would ask you.
It's difficult to say so without looking back at the data, a number of years data, to be frank with you. But this is why I made the point right at the outset. It's unusual to see them trending in the same direction, almost to the same extent. I can't recall which year it was, but certainly not in the last 5 years.
Not recently. So
not recently.
If you could just share by that last slide, please. That's a very interesting slide as well. The other thing I'd want to ask you is, The theme of our seminar really is economic resilience. How confident are we? Now, both consumer and business are not optimistic. However, that last slide shows how many sectors plan to invest and invest pretty significantly, it would appear, despite the fact that they expect profits to be down. So we're talking capex here, and we'll come to the panelists very shortly on that one to see if there's a dichotomy of views here. While on the consumer side, the resilience is there. They expect jobs not to be that great. They expect the economy not to be that great. But they're going on vacation and they're going to invest in other consumer kind of goods. So I am seeing some resilience where we feel that we will survive, we can survive, and we'll find a way. And that's from the consumer side. And from the business side, the opportunity, despite the perceived short-term negative outlook, that their investments are going to be significant. So somebody in the chat, I think it was Jeffrey was asking for that last slide again. So that is what I'm seeing. So how would you answer the question then? Economic resilience, how confident are we? How would you answer the question in one sentence, sir?
Before I go back to the slide, let me make the point that we have to recognize that the last 3 years have not been normal. And I think that question would probably be easier to understand had we not had COVID intervening. And I say so because under normal circumstances, I think we could expect a higher level of optimism or there to be the absence of negativism at this point in time. But we are still emerging out of COVID to a certain extent. And even though the mask mandate is off, you'll find that you go to a number of places and there's insistence on wearing your mask to get in. All right. So I'm saying that it will probably, and the businesses have probably summed it up very well. It will take a while for normality to resume. So whilst they recognize this, businesses are in there for the long haul. I keep making that point. And as a result, businesses that have not had unusual challenges to the point where they're about to close their doors are saying we have to find a way to recover as quickly as we possibly can, but recognizing the constraints that the global crisis that we've been through for the last 3 years have actually placed on us as constraints. So I think whilst the first quarter of 2023 may not fill everybody with smiles and so on, the fact of the matter is that businesses are showing a considerable degree of resilience because they are planning to invest because they know that the way to recover quicker would be to invest and manage their businesses properly. So I think it is not a counter decision. It is a conscious decision by them to say the way in which we can recover is to actually invest in our businesses rather than take a position that, boy, we just have to wait until the thing settles. Because they recognize that we're going through challenges and that and we're not completely over COVID. And we hear talk about new things coming on stream. So these are the kinds of things I believe that's working in the minds of the businesses. With regard to the consumers, I think it is not coincidental, but it is important to note that their thought about taking vacations, I believe, is being fueled by the fact that a lot of people, when you talk anecdotally, people are saying, boy, I just feel like doing a little travel somewhere. And now that the remittances are coming back in the numbers that we are accustomed to seeing it, I believe this is probably also fueling the consumers thinking that, boy, I really need to, I haven't been overseas for 2 or 3 years. I'm going to travel somewhere, you know? And I think these are the factors that are at play based on what we are seeing.
Thank you. Thank you very much. Very, very interesting indeed. before I go to the panelists, there's a question in the chat. Jeffrey, the question concerning the projections for growth, in your estimation, based on insights you have, what are the specific actions that we could implement to sort of move the needle of GDP growth to above 3%? Jeffrey, you want to take a stab at that one? I mean, that will certainly affect both business and consumer confidence.
Yeah, I could. I think, I mean, back to one of the points that Don raised in his presentation regards to projected capital expenditure and the sectors that are looking to invest. I think we have to be careful in looking at the data as well, Don, and maybe you can give further insight, because a lot of it could be mandatory capital expenditure. And by that, I mean, if these companies don't invest in these CapEx projects, they're either breaching regulation and or their asset will not be yielding the returns that they anticipate. I primarily expect hospitality to keep renovating their rooms, because they have to keep the rooms fresh to command higher ADRs. That is quasi-mandatory CapEx, even though it's expensive to do so and borrow to do it right now. They're going to do it because it yields them a very high ADR. As it relates to your question, Andrea, sectors for growth, we still have to look at how we deal with agriculture and manufacturing, because that is where we are faced or challenged the most in terms of import prices. If we can find a way to channel, I see some huge projects on the timeline, and clearly because of confidentiality, I can't disclose what they are, but there's aggression towards getting more into agriculture and agricultural processing. We see a lot of clients going down that route, because there is also incentive from the development banks to get subsidized funding, heavily subsidized funding to do so. So it mitigates the risk of high borrowing costs.
Okay, thank you very much.
No problem.
The first question I saw in the chat was concerning the job situation, the quality of jobs and pay levels. Do you believe that that was a factor in the opinions about the availability / quality of jobs? I mean, that comes in light in the same environment where public sector wages have undergone some amount of reclassification. So the consumer sentiment as to the availability of jobs, has that been affected really by what has caused that, given that we still have a shortage of jobs, 1 and 2, and the existing jobs that are here at certain levels, the pay scale has been revised?
Salary adjustments that were announced recently, because the timing of the fieldwork, we started fieldwork in January, went through to March, and those would not have taken effect or would have been announced until about mid-February, or thereabout in March. So I don't think there'd be a relationship between the two. I think generally consumers have always, at a pretty low level, maintained a certain degree of optimism about things improving as far as their job situation is concerned. And it's a natural kind of response. I can't recall us doing any survey where people think that things are going to get that much worse in terms of their employment. And this is where maybe we need to do some psychoanalysis of some of these responses, because is it a hope or is it an expectation? And I think that's where maybe the rubber hits the road, because consumers have generally not felt that jobs have been plentiful, but even at that low level, they're the kind of optimism that things will improve for the better. And I think it's important to note that it is important that consumers maintain this degree of optimism, even at a low level, because otherwise I believe we may have some challenges that we don't want to have nationally.
Right. Agreed.
And Andre, before you go, just to support Don's point on the consumer spending as well. The data is clear in showing that there's a huge uptick in credit card spend as it relates to the the consumer base, which means that it's about spending available credit and not necessarily moving monies from current and savings accounts. So it could also mean some level of irresponsibility if we don't want to think about that, because the bad debt side of the credit cards is also increasing. So we have to look at how that is parlaying in the data, where people are spending because they can. People are spending for convenience, as Rory would have will allude to as it relates to the convenience of his business. But there is an increase in consumer spending, particularly on credit card consumption.
Right. And we spoke just before we went live. We were speaking about the fact that the consumer business, Mr. Seven Crave can speak to this as well when I give him a chance. Any restaurant you go to not only in the corporate area, but in other metropolis areas of the island. Every night you go to a restaurant, it's full. Monday, Tuesday, Wednesday, Thursday, Friday. So the consumers are spending. There's no doubt about that. They're spending on leisure and they're spending. There's a question in the chat about other countries having been experienced COVID and supply chain and whatever. They don't seem to have the same negative sentiment. And they were asking what are the unique factors leading to Jamaica's sentiment being so sobering. Don pointed to what the factors were, but I'd also point out to that participant that United States business confidence dropped by 24% in March 2023. So if US business confidence is falling by 24%, we are doing spectacularly well in our numbers, because we haven't had that level of fall off at all. So with that as the context, we see our economy really has sort of withstood some of the global shocks as best as we can, not at all levels, certainly. At the lower level, there is some amount of pain still, for sure, but our consumer and our business confidence has not fallen in double digits forever down, as far as I can recall. All right.
Great.
All right. Thank you very much. Very, very insightful as well. So it's just for that participant, just make note of the fact that our main trading partner in the world, their business confidence is down double digits significantly. All right. Madam Jampo President, Shulette Cox, Mrs. Shulette Cox, I welcome you. Happy that you have joined us. The landscape surveyed by Don Anderson shows that consumers are not as confident, but they're willing to travel. Businesses are not as confident, but they're 9% more willing to invest than previous quarter. That is a significant. What are you seeing from the investment landscape of Jampo? How do these figures corroborate what you are seeing and experiencing?
All right, thank you, Andre, and let me thank everybody for being here this morning and JCC for inviting Jampo to participate in this discussion. Mr. Anderson, thank you for your very detailed presentation on what the economy is looking like in terms of consumer and business confidence. As you know, Jampo really focuses a lot on our business partners, not so much on the consumer side. So I kind of focus on the discussions there. And I will say that what we are seeing concurs with what Mr. Anderson has presented, in that over the last year, we have seen where investment decisions have stabilized. When COVID started, we saw a number of investments get placed on hold, and a couple of them got cancelled. But for the last year, we can say that we've seen where projects that had started in the late stages of 2021 are progressing, and those investments are moving forward. We've seen a situation where a number of reinvestment projects, so those are expansion projects or growth through new jobs being created, those projects have also continued. And I suspect that a part of that is because how we interface with our clients is a little bit more longer term than quarter to quarter, right? The other thing that I would want to highlight is the discussions generally were broadly talking about the sectors. But for us, we see the differences in the different sectors that are actually being facilitated by JAMPRO. And I was very encouraged when Don went into the fact that businesses identified government policies or government direction as one of the top 3 reasons why they have a little bit of confidence that things might improve over the next 12 months. And a couple of cases in point for us is we had a budget debate just about a month ago. And for example, film is an industry that JAMPRO facilitates. And the Jamaica Screen Fund was announced by our Minister of Finance. And that announcement of $1 billion being injected in the industry over the next 2 years has caused optimism in that industry, for example. We also had a case of Minister Vaz making a commitment about the issuing of the renewable energy RFP. And again, when that happens, that's going to have a significant impact on all the industries that are affected by the energy prices. So there are things that affect different sectors in different ways. I do agree that in terms of the expectations and that kind of being lower, no, over the past years, and I think everybody has said it, we have the war in Ukraine that has emerged and is having an impact. We spoke about the global supply chain issues, and Andre, if I could, the question that was asked about what is unique about Jamaica, why supply chain issues would affect us more than other countries, is because Jamaica, unfortunately, is heavily dependent on imports, not just as final products, but even for our productive sectors, we have a very high import bill. And as an island, it means that everything comes in either by air or ship. And so global supply chains do affect us very significantly. On the local side, some of the things that have been affecting our clients and their outlook for the next 12 months has been, as NCB indicated, the movements in interest rates. A lot of our clients look to access to financing when they are expanding. And with a tightening of access to financing, their plans have either been rescoped to be a little bit smaller, or they have decided to just move a little bit slower in how they implement. And of course, that is going to be an impact. We also are seeing, based on the tightening of the labor force and the access to the labor that companies want, that has been a challenge. And we are also, it's kind of twofold. It's not just in terms of numbers, but productivity has been a big discussion among investors over the last few years. And as the labor force tightens, that has become a bigger discussion. So how do we counter these challenges? I think from the government perspective, what we know we have to do is to optimize based on what we have control over. So we've talked about some of the things that the government has announced that it's doing, and we have to make sure that as a government, we maintain those obligations to impact sector and sector growth the way that we plan to impact it. So that includes moving forward with things like the energy RFP, moving forward quickly with the screen fund, but also it means that we have to go broader when we think about our workforce. So I think a lot of people might be aware that there has been a very targeted approach to upskilling the workforce for industries like the outsourcing sector. And JAMPRO manages a whole program around upskilling for that sector. But now we are challenged to look at how do we upskill for other sectors? How do we upskill for manufacturing? Manufacturing is a sector that has not cried out about labor in a very long time, but we are now getting that cry about what can be done for that sector, for construction, so that we can maintain competitiveness. and looking at productivity and how we implement or facilitate things that can improve productivity in the near and long term. One interesting thing before I wrap up, Don didn't get into it in his presentation, but I did see it in the notes, is that businesses talk about the fact that they were not operating at capacity. They're operating at like 70% capacity. And one of the reasons is that they are seeing a decline in the demand for goods and services. And this is one of the areas that JAMPRO is looking at very strongly, because anybody that has ever heard my minister speak will know that he speaks very strongly about exporting and the fact that we cannot focus on the Jamaican market to demand our goods and services. And so I invite those companies to talk to us at JAMPRO, because if you can't find the demand, we will help you find it. So I want to end there, and those are my thoughts.
Thank you. Thank you. Thank you very much. Coming back to you. Excellent, President. Thank you very much.
You're welcome.
Mr. Barnes, Managing Director of FESCO. Looking at these numbers, how does it equate to what you are seeing on the ground in your business? You have a captive audience for your product. We don't have option but to buy it, but we certainly have to make some other decisions. How do you see, do these numbers equate to what you're seeing on the ground?
Well, I guess you're asking me a couple of questions from both on the consumer side and from on the business side.
Well, consumer first.
Okay. Regarding the consumers, I mean, we've been very grateful over the past, 2 years, and it continues to do. We're very grateful that our patronage has increased every month. And at FESCO, we don't just measure in terms of dollars; we measure in terms of actual units, which is liters. So, on a quarterly basis, our throughput of liters has increased. Our footprint has increased, and we continue to make investments. And what we've seen from the consumers is that the consumers have developed affinity for our brand. So they continue to patronize our stations, at good rates. We have not seen any decline across our network. What we have also seen is that, I guess, in the tourist affected areas, there has been an uptick in the throughput at those locations. But overall, generally speaking, consumers continue to be attracted by our brand. I hope they will, take on our LPG brand, which we plan to launch in the coming months. But from the consumer side, we have not seen any decline to date.
Right. On the business side, the last slide, Don, to ask you to, if you could find it back. It showed, I've never seen, in as long as we've been doing this, that slide has been part of our presentation for about 4 years now. The businesses that are looking to invest, a significant amount are looking to invest, and it's not something that I've seen. Would your sector of the economy, Jeremy, be looking to invest as well in terms of expansion in this difficult time? It says there that businesses were, confidence fell by 5.4%, but several are looking to invest. Would that also equate to what you're looking to do in your sector?
Well, businesses, and especially my business, we have to look forward and project our business, 3 to 5 years at a time. Any CapEx spend or projects that we plan to do are actually 3 years in the making. So we can't just stop on a dime and stop our investment patterns or investment programs, because they have been in the making for 3 years. What is important, what's going on right now, is actually that interest rates have increased significantly. They have stabilized in the last few weeks, but for the trend for all of last year was a constant increase in interest rates. That combined with the effect of interest rates on capital markets, which Timar and Jeffrey will talk about, that asset prices have actually come down. The combination of the two makes raising capital more expensive. So you don't get the capital prices if you're to do IPO or APO. And if you go to the debt market, you're going to have to pay more in interest costs.
Yeah.
So what that forces companies to do is actually earn more, because one of the cheapest sources of financing at this point in time will be retained earnings and making profits.
Mhm.
So, that side of, capital raise, I think, a lot of companies will look towards doing, just for the sheer cost of the increasing cost and interest costs has been very, very significant. In addition to that, there are some increasing security costs that, companies are facing and will, are programmed to face in the coming months, given some of the security challenges that are out there, cash handling one of them. So I can see why, at this point in time, business confidence, based on both raising capital and the effect that it has on the balance sheet regarding balance sheet and P&L statement meaning interest cost. I can see why there's, somewhat of a dip in business confidence. But if you're talking specifically about CapEx spending is pretty typically programmed months and years in advance. So to see the changes in CapEx, I'm not sure how, it's factored here, but that has a lag. I do know on our side in the last, let's say, 24 months, between our dealers and our company, we have spent in excess of $3.5, close to $4 billion on CapEx. And going forward, we still will be spending on CapEx because, again, our industry, was resilient during COVID and it has proven to be resilient so far this year. And again, it's a lot to do with the customers and the support that we get from our patrons, and we do appreciate it.
Thank you. Thank you very much, Jeremy. Very insightful. Rory, the man on the ground, retail business, it says here, retail, 60% of the people in retail are looking to expand. Before you answer that part, of the numbers that have been presented by Don, the statistics that have been presented by Don, that shows a fall off in confidence. Have you seen that in your sales? And how does it stack up against what you're seeing?
All right, so thank you so much, Don. That was a very good presentation. I've learned a lot actually. Now, regarding the sales, our revenues have been increasing, and that's just due to exposure. But to measure confidence, we would use probably the average ticket size in terms of what's the average amount a customer would spend on food. And I'm a mathematics person, so it is the same graph that I see Don presented. It's similar to a parabola, a quadratic, right? Where you have the U shape. So you have ticket size was high. We hit the pandemic, it went down, and now we are seeing the back of the turning point. So it's going back up nicely, and I think persons have more, disposable income. We are seeing where the propensity to consume is increasing. So that's typical for Jamaicans. I give them more money, they spend more. And interestingly, when I saw Don's presentation, I saw where businesses are expecting prices to rise, and we saw where consumers are expecting prices to rise as well, and that is exacerbating the inflationary pressure, right? Because we know that once you think that price is going to rise, you're going to want to spend more now, right? And business will want to increase their prices to offset whatever expectation in terms of price increase. So I'm concerned, in terms of how inflation will be looking in the short term. Just the mere fact that both businesses and consumers are expecting really expecting worse in terms of the economic condition. But in terms of what I'm seeing persons spending more now. Persons are spending more towards convenience, and that is largely caused by what happened during the pandemic. We were facing lockdown, and persons changed their spending behavior. Persons don't want to move anymore. Persons are quote unquote becoming more lazy, right? And so persons are spending more towards convenience. And I think when you look at it and the fact that you put more money in a Jamaican hand, him ask you, where money go, right? And the thing is that if you look at that, then maybe the government probably needs to, look at a balance between consumption tax and income tax, maybe need to give the people more money. People want to spend it, right? They want to spend it, And, there's a large, quote unquote, underworld where a lot of persons not paying income tax. We know that, right? A lot of persons not paying PAYE. We know that. But a lot of persons spend, and they are spending heavily. But even though they are not so optimistic about the condition of the country, I think if you give them, and it shows in the report, if you give them the money, right? They want to, I just saw, I think Dan presented it, more persons want to buy a house, more persons wanted to buy vehicle, and we had more persons wanted to take vacation. So they give them more money, them ready to spend. And we see that, and I think it's a good look on the economy in terms of spending and investment, but I just think that people are not getting enough, and so people are they're skeptic in terms of what they do with their money, because they believe that it is not enough, in a sense. Let me just put, I don't want to say the wrong thing, right? But the business is seeing growth. We are doing expansions, and Dan also showed here where wholesale and retail, 60% are looking to expand. We've recently expanded to do grocery delivery with 7 Crave Mart. That was because we saw where persons were, believing in convenience and seeing where that productivity could increase by just staying home and not having to join the long lines, and giving up 2 hours of a day. And so, we saw that, and we saw where, grocery delivery would be something good to, go into. But at the same time, we have to look at our capital risk, because capital investment is extremely risky right now. And I think Jeremy was alluding to that, because one of the things is that you don't want to spend a lot of money, pump it in capital investment, and then the customers not giving you the return, right? Mm-hmm. And so you have to look at, where exactly do we spend our budget for capital expenditure. And what we saw was that the best thing was to still focus on convenience. So it's not just, okay, we're going to give them delivery from restaurants, but now we're going to give them delivery for their favorite supermarket items. And so persons right now, when we just launched it, we saw where nobody was really gravitating towards it. And over time, people realized that there's a need for me to stay home, be more productive. Remote workers are on the rise, right? We know that and largely caused by the pandemic, right? So persons are staying home, persons are saying, listen, I cannot bother to go in a vehicle and drive to the supermarket and then, having to wait in a long line and all of that. The problem we had, and we discussed it when we were thinking about expanding, is that when persons are looking to get groceries, persons generally want to pick out the items themselves, right? And that was the only reason when we do our survey, persons would want to go to the supermarket, right?
Well,
and
Jeremy,
so we've seen.
Wants to drive to the supermarket.
Yeah, repeat that.
Jeremy wants them to drive to the supermarket.
Right. So
supermarket at some of our locations.
Okay, excellent.
Right. So I mean, I am very optimistic, honestly, about the environment, and I think in 2 to 3 years' time, the confidence will surpass pre-pandemic. Definitely, okay. That's what I believe. Given all the vast increase in technology, we're seeing all of these things coming out, and you have the chat GPT, I see persons say, okay, we're not going to talk about that. No, that's a whole another topic by itself.
Yes, but we're saying, so you're seeing really that businesses are sticking, based on what Jeremy said and what you're saying as well. And well, all three of the panelists, businesses are sticking to their strategic, long-term, medium to long-term strategic plans, despite the
Consumer.
situation that they're seeing here now. Thank you very much, Rory. Dan, Rory raised the question about the security costs. No, I think it was Jeremy who raised it. The likely increase in securities costs will have an impact on the bottom line in businesses. Was that part of the, I don't remember if that was in the top 5 reasons for the pessimism of the businesses. Did anyone indicate just the rising costs generally, but they didn't speak specifically to security? So, I mean, the rebalancing of the security costs, did they?
No, not specifically, but you can probably allude it from the fact that they thought that crime and violence was a major factor, you know, and therefore you could stretch the point to say, well, obviously there's going to be greater security costs involved. So that, but there was no specific mention of that factor. That probably clouded as I'm making the point in the whole question of crime and violence being such an important factor in their overall costs.
Right, right. So based on the historical trends done, given now, we've been here before where interest rates have risen, interest rates have started to come back down. There has been stability in terms of the consumer price index. In the past, could you say how quickly the economy would respond to those stimuli? Say that from the perspective of, there's a question in the chat, which I will ask Tamar to look at actually, in what we expect to see, given the CPI slowdown, what we expect to see as a knee-jerk or a immediate reaction in terms of business and consumer confidence in subsequent quarters. Would it be safe, done first, to say that using the statistic, what you saw in previous times, that in the next quarter or two, we should see a reversal based on what historical trends?
We have asked the question in the past of businesses, how long do you think it will take for us to rebound? And generally, certainly 2 years ago, people were talking about 2 to 3 years that they may rebound and actually begin to see a longer series of positives. It is the trend data, of course, is the most critical measure of going forward. And I think it probably is a bit early, but we've seen 2 quarters of decline as far as businesses are concerned. And that probably is a little bit worrying, but again, just going on the basis of what the other panelists have said, that despite what they see as some setbacks, the capital expenditure and the evaluation that they make is 2, 3 years and 5 years. And therefore, they will put all that they can behind their businesses to ensure that whatever capital expenditure is made actually realizes some kind of positives for them. I would like to think that maybe in another 9 to 12 months, we can see a turnaround. But again, it depends on what happens in the second quarter of 2023. If that shows another decline, then I may need to reassess my particular position. But we haven't seen anything like that 24% decline in business confidence in the US, which would be far more worrying than that 5% that we saw.
Exactly.
So, and again, that 5% is against the background of a fantastically high increase in business confidence in the third quarter. So in a way, you can probably think that the thing is probably readjusting itself in the first quarter of 2023. And what will help us to determine how long this might take is what the second quarter of 2023 shows. And we're well in the field with that. Again, of course, by the end of June, we will have completed field work on this.
Right. The other question I didn't hear mention of is in the last quarter, unfortunately, one of the negatives was significant reports of fraud in financial sector and elsewhere. that I thought would have had a bearing on business confidence. Did that come up at all in the picture in terms of interviewing businesses?
No, and I think perhaps because they were so specific, there were banking sector in one case, and most recently last week, of course, that would be outside of fieldwork time. But I think because they're so specific to institutions, even though a number of consumers were hurt, certainly in the big case that has been celebrated around town for the last couple of months. But this did not come up as a specific item of mention spontaneously. And of course, there was no reason to prompt it in the survey.
Right. Okay. Well, the bottom line is that the fundamentals of the economy remain strong. Timar, over to you for that. In terms of what you are expecting to see, given the CPI leveling off for now, what are you expecting to see in the next couple of quarters?
Well, Andre, there are a number of things to consider as it relates to inflation. So what we've been seeing trend-wise is inflation trending down towards the target range of 4 to 6% set by the BOJ, right? When we look at the trend line, we're seeing, when you look from April 2022 out to March 2023, except for 1 month, which I believe was November, between the November-December period, there would have been a decline in the point-to-point inflation rate, right? Of course, the factors driving this is factors such as reduction in imported commodity prices, including the fuel, grain, consumer prices as well, would have been, as a result of these, coming down. However, despite this trend, there's still significant risk to Jamaica's economy because we operate in a global context, and the geopolitical issues that we mentioned are still not behind us. We still have the potential for higher than projected imported inflation. You know, there's a general sentiment and expectation that we could see a number of major economies going into recession this year. And I would have pointed out earlier in my presentation as well that for the US in particular, one of our major trading partners, there's a 99% probability that they will have an inflation this year, right? So when you combine those factors with the fact that the Bank of Jamaica has been implementing measures to tame inflation, specifically using the interest rate mechanisms that they have, as well as other measures, it really, it's a complex system to understand and predict. However, the expectation is that for Jamaica, going into December, we'll see inflation coming within the target range.
4 to 6. Okay.
4 to 6%.
And that should ease some of the uncertainties in the consumer and the business confidence, you think?
I suspect so. However, the truth is that while that is the case, and you have the BOJ on one hand implementing these measures, right? Expectations around inflation and consumer confidence and business confidence around, the direction of it there might be some kind of disconnect because there's also the external factors at play, which many persons are aware of, right? And if you listen to just the external factors, you think, boy, it's gonna be a doom and gloom for the rest of the year. However, Jamaica in particular has proven to be fairly resilient despite the external shocks. And the hope is that we'll continue to be able to weather the storms, no matter what is happening externally.
All right. Thank you very much. All right. In the interest of time, thank you very much, Timar. Question for the panelists. I'll start with Rory and then Jeremy, then Mrs. Cox will have the last word. the one thing that you would want to see that would certainly assist in propelling your particular business forward, whether it is commercial, legislative, whatever, that would assist you in improving the quality of your business, in allowing you to employ more people and allowing you to be more productive? Is there any one thing that you can point to, whether legislatively or otherwise, that would assist you in that regard?
That would assist me.
Yeah.
So, as I said earlier, right, one of the major factors of our business is having more money in the hands of the citizens of Jamaica, right? And if the government and the legislatively now, look at the consumption tax as well as the income tax, and I think they can strike a balance where more money can be in the hands of the people, and therefore it can increase GDP significantly. People will be more comfortable in terms of their jobs. People will have a better quality of life, and I think that will. And if you have that on a long-term level, then ultimately we expect to see crime reducing. Persons able to live, as I said, because really truly it's a quality of life. That is what is driving the crime. People think that, listen, nothing going on in my life, nothing going on to me, and so I have to do this. And so I think if there is a right balance between what we have and how much we spend, right? I think it would be better for not just my business, but Jamaica on a whole. That's what I honestly believe. And so I just think that the government needs to give it a look and see what can be done.
Very, very critical point. I think you're pointing now towards social investments.
Yeah.
Thank you. Thank you very much for that. Thank you very much. I was hoping that one of my panelists would touch on investments in the people. So that is an excellent observation. So, and obviously that has to come with skills training, etc. But you're pointing it in the right direction in terms of social investments. Jeremy?
Yeah.
Right. Actually, I have two. The interest rates, if we can get them, stabilize and decreasing, I think that would, allow greater capital expenditure. And I think being a junior market company also, if we could get the threshold raise from, maximum capital raise of 500 million to even $1 billion or, at minimum 750 million, I think that would enable a lot of companies to come to the market and raise, the junior market and raise significant sums. I think the threshold right now at 500 million is just approximately 3.5 thereabout million US.
Yes.
Has been decreasing since the inception of the junior market. So I think there needs to be an adjustment to that threshold that would allow, smaller companies to come to the market. And also, companies already came to the market to be able to raise additional funds to further expand. I think those two items, interest rate reduction and raising the junior market threshold, I think those two things would be best at this time.
Thank you. From where I sit, I'll tell you that the proposal has already been sent for consideration to move the threshold on the junior market. So we're awaiting feedback from the minister particularly. So we hear your cry on that, and we're working on that one. So thank you very much, Jeremy Barnes, Managing Director, FESCO. Ms. Shulette Cox, President of JAMPRO, your question will be a little different because of where you are. I would say what you think the one or two things that we would do to make Jamaica more globally competitive at this time.
So Andre, if you know me, you know that I have a laundry list. So you asked me to pick out of my laundry list. But I want to go back to what you just said a while ago, and it really does come back to our people. JAMPRO really focuses on selling our people as one of our best assets. And I think the work that we're doing in training our workforce and looking seriously at making our workforce more productive is going to go a far way in making us attractive, not just for foreign investors, but even for our local investment community. I think it really starts there, and that's the fundamental strength that we need to focus on.
Thank you very much. Thank you very much. So we have come full cycle. We spoke about investments in infrastructure. We've spoken about investments in people. Together, we believe that these factors will assist us in continuing to be resilient economically and to continue to boost the confidence of others in our market and of businesses and consumers locally and across the globe. Ladies and gentlemen, the 100 and odd people online, I thank you all very much for joining us. We hope that you have found this presentation today to be inspiring and insightful. We thank certainly our sponsors, National Commercial Bank, NCB Capital Markets. We thank specifically Mr. Jeffrey Brown, Structuring and Loan Syndication Specialist at National Commercial Bank. Timar Jackson, Assistant Vice President, Origination and Structuring, NCB Capital Markets. Our panelists, Mrs. Shulette Cox, President of JAMPRO. Congratulations again, and thank you for joining us and sharing your insight. And we look forward to you being a standard member of our panel as you bring further insights. So Mr. Jeremy Barnes, my colleague and friend from FESCO, continue to do what you're doing, sir. I think you have a good brand and continue to create opportunities for Jamaica. Likewise, Mr. Rory Wright, Chief Executive Officer, Seven Creek. Thank you very much. Also, of course, to Executive Chairman of Market Research Services Limited, Mr. Don Anderson, for another very insightful presentation. The comments coming in are really good. Before we close, we have a box up from the public, just very short, on their thoughts on where we are. Let's see how it stacks up against what we have all just discussed. I should really have put that in right after Dan's presentation, but in anxiety to get my panelists involved, I seem to have overlooked it. So I'm going to ask Tajay, if you could just share that now, just before everybody departs, the quick box pop, and that will be the last thing presented. Thank you very much, ladies and gentlemen.
Hi, I'm Jael Country Cook, the founder and creative director at Spaces. Spaces is a Jamaican-based furniture retailer dedicated to creating an environment that gets our customers excited about home decor and design. In 2023, one of the things that we want to do is to increase our digital footprint. Coming out of the pandemic, consumer behavior has changed. And even though restrictions have lifted, how consumers shop and access goods and services has changed, and we have to change with this. And as such, one of the initiatives that we're doing is to build out our e-commerce platform better, to make it more user-friendly, and to have it as a reference point so that people can understand and see all the various value-added services that Spaces now has to offer, including our interior design and virtual design services. Since the beginning of the year, we have been reevaluating our business, looking at our current suppliers and our trade partners to see how we can reduce the cost to our clients. Inflation affects everything that we do, from our freight to the cost of the goods to ultimately the price that the consumer pays. And what we want to do at Spaces is to offer our clients value. We reevaluated our partnerships with our suppliers and looked at other aspects of our businesses where we could minimize costs. Ultimately, we understand that the Jamaican consumer is also faced with the burden of inflation, and we want to be able to reduce our costs so that the final product to our customers is something that's of value to them. One of the things that we've done since 2020 is to transform a brick and mortar store into a home design solution center. And as such, we've also rushed into a digital transformation where customers can now access our services online. One such new service is our virtual design service, where you can stay within your home anywhere in the world and access our interior decorators and designers. Another thing that we're doing is to put our entire catalog of furniture and home decor online, and you can access this through our Spaces website, spacesjamaica.com, where you can check out and browse our extensive collection of furniture and home decor items. To be successful, one must always be reinventing themselves. It's important to listen to your customers, to hear the good and the bad that they have to say, and to make the small changes that are required to give you the big results. Reinventing is looking forward to the future. Reinventing is also paying attention to what's happening now and being able to adapt to the changing needs of the consumer. And I think this is why over the last 15 years, Spaces has become and is still relevant today and will continue to be relevant in the future.
Was to get a dream home and a nice vehicle, but circumstances and situations didn't allow me to reach my goal as fast as I expected it to. Now I'm one the next 2 years or whatever now due to illness of my parents and a lot of financial struggles and difficulties, there has been a lot of setbacks. So, still expecting more, but after just wait and the process and the time.
Well, not too bright, not too bright, But as I say, as a seller, we have to fight, back up, give thanks, grateful, and know so we start another chapter, another year. That is it.
It's up and it's down. It's not really settled as yet, as I said, due to the fact of the illness of my parents and a lot of financial struggles and difficulties. So it's not yet settled.
Well, not pretty, Like hard, Like when it comes to the days, but as I say, when it comes, better feed, you understand? Give thanks and grateful, see you.
Thank you very much, ladies and gentlemen. Thank you to the panelists. Thank you to the sponsors, NCB Capital Markets, National Commercial Bank. Have a good day, everyone. Stay tuned for our next quarter. Done? Looking forward to the next quarter.
So am I.
Have a good day, folks.
Take care.
Take care, everybody. Bye.
I know.